In this video, we will go through the introduction of financial markets and institutions. So why study financial markets and institutions? Well, as you can see, markets and institutions are primary channels through which capital is allocated in our society. In other words, there's money in an economy, and it could be in savers, spenders, households, businesses, etc. However, in order for that money to move between these entities, these financial institutions and markets facilitate that movement. The classic example is your bank account. You work for a company deposits money in your bank account, you access your money through there and use it. That will be an institution. We will get in more details in the next few slides. So, investment and financing decisions require managers and individual investors to understand the flow of funds throughout the economy. So, as a finance person, or not necessarily a finance person, but working in a position which requires to know about the financial situation of your department or even your personal finances and your family, it's important to understand how this money moves across these institutions. Managers and individuals must also understand the operation and structure of domestic and international financial markets. Part of understanding the operation and structure helps to then make decisions that can work within that operation and structure in the most efficient way possible. In addition to that, understanding the laws and regulations that govern these institutions will allow you to then also make decisions that do not end up breaking the law. So all these things are important. Let's start by defining some of the common terms or the overarching terms of these markets and institutions. So we'll start with primary markets versus secondary markets. While they have a good definition here on screen on the slide. The easiest way to look at it to start understanding is when a company issues stock or shares into the market. So they're selling shares into the market. That will be considered primary because it's the actual company or corporation selling to the public. So the public is literally given money directly to that company as they buy those shares. However, later, once the public has purchased those shares and they want to sell it, they can sell it to another investor. At this point, the money goes from the new investor buying the shares to the old investor who is selling the shares. So the money only moves between those two people. The corporation does not receive that money. The corporation does and can benefit from that transaction in other ways, but they will not be receiving the money directly in that sense. So primary markets is when the actual company sells shares to people or investors and they receive the money. Secondary market is when they sell between themselves, the investors, and the company's not part of it anymore. Continuing on the primary versus secondary markets, here's an illustration of how then a financial institution and a financial market play a role. In the primary market, when the company is selling to the public, they may use what we call an underwriter with an investment bank. So when you hear the term investment banking, this is one of the things they do. The corporation contacts them, they put the thing together, and then they help issue the shares to the public. So these investors will buy those shares. So the shares go from here to them, and they sell it to the investors. The investors give them money. They keep a piece, depending on how they agreed upon the contract with the corporation. And then the money goes there. So shares go that way, money goes this way through an investment bank. That will be a financial institution. When you have now the shares are out there and investors trade between themselves, as you see investors here and investors here, the company does not participate here. So you can call this the New York Stock Exchange is a marketplace where investors that purchase here, so these investors that purchase from the company are now these investors here selling shares to other investors through, let's say, the New York Stock Exchange. And these new investors send money that way. And that's pretty much the key difference between primary markets and secondary markets. As we continue to define these institutions and markets, let's talk about money markets versus capital markets. Generally speaking, sometimes it could be exceptions to the rule, but generally speaking, the general definition, a money market is where debt securities or instruments with maturities of 1 year or less are traded. So anything that has less than a year of maturity, for example, a bond, is a debt instrument. And if it's less than a year, then that will be traded in the money markets. Capital markets focus on anything that matures over a year or does not have a maturity, like stocks. Equities and stocks, as long as the company is active and alive, they just keep on going. Bonds will have a maturity date. Foreign exchange markets, just what it sounds like, is where foreign currency is exchanged. Just like stocks and bonds can be traded in the financial markets, there's a foreign exchange market where people can buy and sell or exchange and trade currency. So, foreign exchange risk is the sensitivity of the value of cash flows on foreign investments to changes in the foreign currency's price in terms of dollars. Now, they're looking at it from the US perspective. So I will give an example of what that means. Let's say you are what we call a domestic entity, a company inside the United States, and you're doing business with, let's say, Germany. And that would then use the euro over there. So depending on how the contract was written, you may have this foreign exchange risk or not. One party will have it at least. An example, if when you enter in a contract with Germany, and let's say that you are selling to them, whatever product it is. So you sell them the product. If the contract says that they will pay you in dollars, then you do not have this risk because you will receive the payment in dollars that you agreed upon. However, if the contract says that they will pay you in euros, what happens is if the value of the dollar against the euro changes in the future, you could end up with less dollars after it gets exchanged. On the flip side is you could end up with more dollars if the value changes in your favor. Because for them, there's no risk because they already agreed on the amount of euros they will pay. So they just got to come up with those euros and they just pay you. But you are receiving euros instead of dollars, it may go up or down in value. And that's where the foreign exchange risk happens. If you are receiving dollars Here in the United States, you don't have that risk, but then they have the risk of having to buy dollars at different prices. It could work in their advantage if the euro goes up in value, but it can also work in their disadvantage. Now, uh, there are ways to hedge or protect yourself against these issues, as with contracts and other financial tools, but that's for a different discussion. Derivative security markets. Let's first define what a derivative security is. A derivative security is a financial security. The examples that you probably hear all the time are future contracts, options, swaps, mortgage-backed securities, all those fancy terms that you have heard in the movies, credit default swaps, etc., whose payoff is linked to another previously issued security, such as a security traded in capital or foreign exchange markets. Each one of these will operate differently, but let's use options, for example. When you buy an option, it's a derivative security on a stock, on a share of a company. And as that share or stock price changes, the value of your option changes. Now, the reason it's called derivative because when you buy the option, you are not buying the stock. You do not own any shares. You have a choice to own them, but you do not when you buy the option. And that option will go up in value relative to the security that is tied with or that is following. And that's what's called a derivative. The value of the option is derived from the value of the actual security, which you do not own. You could own it if you exercise the option, but when you buy the option, you do not own it. But the option itself has value that goes up and down. There are various drivers of why the option changes value, but obviously the price of that asset, in this case, the stock or the share, will be the one that drives or that's derived from. Derivatives are traded in derivative security markets. The big one is in Chicago. In the United States, the big one is in Chicago. Generally involves agreeing between two parties to exchange a standard quantity of an asset or cash flow at a predetermined price and at a specified future date. What that means is that for you to sell or buy something, there has to be somebody else that's willing to sell or buy something. So you're going to buy something, but nobody's selling it, then you can't do it. There's no choice, but that's pretty much with everything. If you want to buy a car, somebody has to be selling a car, and vice versa. You want to sell a car, somebody has to buy your car. So that's just good old fashioned market. They have to be buyers and sellers that agree to the price and the asset or service. In this case, assets. Derivative markets are the newest of financial security markets and are also potentially the riskiest security. Now, when it says newest, yes, is the newest, but this has been around for decades. This derivative securities are older than many of you listening to this recording. So it's just the latest. So the word newest could be deceiving, making it sound like it's fresh, like recent. It's not. Newest and recent do not mean the same. It's just the latest that in the financial world. So we do not live in the wild, wild west. We do have financial market regulation. Now, is it perfect? No. We go through ups and downs. People find new ways to work around these, and that's when you hear the scandals. But we do have something in place, and we are probably one of the better ones around the world in the sense of maintaining controls without crushing the business opportunities of these financial institutions and markets. There is a balance. A lot of people say we should need more regulation. Sure, there is a healthy level of regulation needed, but we always got to keep in mind that more regulation takes away ability to conduct business. and it takes away competitiveness against international markets. Now, I don't want you to think that, and then the opposite, let's have low regulation. No, the low regulation allows for a lot of bad activity. So it's tricky to find that balance where we can properly and efficiently manage our financial markets and institutions without allowing bad actors to get away with bad things, but at the same time, not crippling them where they cannot do anything. So it's tricky. Uh, and all we can do is we have a set of rules or regulations. Things are going well, but when something bad happens, then we got to change them and adjust and adapt. Uh, and it's just that back and forth game because at the same time, you want these to be successful and thrive. It helps the economy. So the SEC, the Securities and Exchange Commission, is our main institution that regulates the financial markets. The main emphasis of SEC regulations is on full and fair disclosure of information on securities issues to actual and potential investors. SEC monitors trading on the major exchanges to ensure stockholders and managers do not trade on inside information about their own firms. So the two big things is preventing inside information, or at least regulating it. That way it's a more fair playing field for all investors and no one can take more advantage over or have an unfair advantage. And at the same time, make sure that the information that goes out is not fraudulent. Now, as you know, there still happens a little bit of inside information going on. And yes, fraudulent information does get out there. The best they can do is catch it as they go and minimize the impact. Regarding the financial institutions, here's an overview. Financial institutions perform the essential function of channeling funds from those with surplus funds to those with shortage of funds. Now, it sounds like, well, shortage of funds sounds like a bad thing, but it's not shortage. It's just saying we need capital to move our business forward, to grow our business, right? So imagine a business that says, okay, we do have money, but we're going to need more capital to keep on growing the business or take advantage of new opportunities. So technically speaking, if they don't have all that cash on hand, then they have a shortage of funds, but it just means it's better for us to raise capital through more investment money than to then just wait for us to come up with the cash to do it. So then the surplus of funds will be the people that have some money to buy shares, for example, or bonds. So those are the investors. So the idea as a financial institution, like the investment bank that we spoke earlier, facilitates that transaction where the people that want to invest can then put their money, move their money in that direction to get to the corporation so they can use it to raise capital. In a world without financial institutions, the level of funds flowing between suppliers and users will likely be quite low due to the following reasons: monitoring costs, liquidity costs, price risk. Okay, generally speaking, what it is imagine a world that there is no New York Stock Exchange, there are no investment banking. So all these corporations and businesses alike will have to then themselves go knocking door by door saying, hey, I have this business, we'd like to invest. So the problem here is that here's the monitoring cost, for example. How would you know that that's a good investment or they're a legitimate business? These investment banking and the SEC and stuff like that help regulate that by checking on these things. The analysts check on the company, the SEC checks on the information that it's not fraudulent, and things like that. So that way you have these people in between that will check on these things for you. Liquidity costs, then, well, once you buy or invest in that business and buy a piece of it, and then later you want to sell it, it can be very difficult to find another buyer because now you have to go door by door, see who wants to buy it. Instead, you have the New York Stock Exchange. where you can just go ahead and submit your sale there and somebody anywhere in the world can buy it. Price risk, well, that comes a lot with the monetary and liquidity cost. The price of an asset, there's so many things involved in there. But the point is that how would you be able to then get a good price for the asset, whether it's a corporation first raising capital or you trying to resell the shares? There might be a price risk involved because it'll be more difficult to for the price to be a fair value. It's called price discovery, which these institutions help as the process happens. The supply and demand works around it. Other things that come in play is enterprise risk management. Enterprise risk management recognizes the importance of managing the combined impact of the full spectrum of risk as an interrelated risk portfolio. More on that in a minute. Seeks to embed risk management as a component in all critical decisions throughout the financial institution. Popularity rose as a result of the failure of advanced risk measurements and management system to detect exposures that led to the financial crisis. Stresses importance of building strong risk culture. Generally speaking, what they're talking about here is that before a bank or any other financial institution or any business for that matter will measure risk on a project by project transaction or department by department, but never the company as a whole and how one department or one project may impact or change risk in other areas of the business. For example, in this case, because they're talking about the financial crisis, banks, they have a whole set of risks they have to manage in order to have an enterprise-wide risk management system. So their mortgage department and their car loan department and their investments department, all those have to be managed in a way where there is some individual management going on, but at the same time, they also have to measure how they are interrelated with each other. The financial crisis, it was their bonds slash mortgage security backed mortgage backed securities, etc. The risk there was so high that it didn't matter how healthy the rest of the enterprise was, it just pretty much destroyed the enterprise. So this is a rough example or a simplified example of this enterprise risk management. Generally speaking, what they're talking about is you cannot only measure risk by the departments or the projects individually or sections in your business. You want to do that, but you also have to have overarching picture of how everything together is a risk for the entire company. FinTech, short for financial technology, refers to the use of technology to deliver financial solutions in a manner that competes with traditional financial methods. It includes services such as cryptocurrencies, Bitcoin, blockchain. Everybody should have heard that by now. Blockchain is really the fintech part. So it's services that support the cryptocurrency. The cryptocurrency itself is a technology coin, right? And it falls fintech. Blockchain is more of what the fintech is about. Financial technology is really that the technology that actually is supporting these things. Fintech risk involves the risk that fintech firms could disrupt business of financial services firms in the form of lost customers and lost revenue. So they're really talking about not the risk of a fintech company, but the risk that fintech represents to the other financial services. For example, the blockchain of and Bitcoin, there is no central place there. People do trade it and make money, or people manage people's accounts and make money that way by fees. But the blockchain itself, the ability of people to go ahead and trade Bitcoin through a blockchain with no fees would have effect, for example, wiring services, Western Union, for example, or when banks wire money internationally, they charge fees for these things. Well, they're losing business to that because now people can do it through a blockchain. Now, it's not completely taken over. That's just an example of how some revenue is being lost by uh, financial institutions are losing some revenue because of technology. Another example that you may be familiar with is when Robinhood, the trading platform Robinhood, first came up. They were the first ones to do transaction-free trading. Before that, it could have been as low as $5 and as high as $12 per transaction. And if you did high volume, you paid even more. So every time you traded, you had to pay them, let's say $10 for every transaction. When Robinhood came into the game, now everybody had to catch up, and now everybody does transaction-free trading. Now let's talk about globalization of financial markets and institutions. Now we're looking at the international picture. United States markets are the world's largest of financial markets and institutions. We are really, really big compared. But international markets have seen rapid growth in recent years as a result of various factors. Pool of savings in foreign countries has increased. International investors have turned to United States and other markets to expand their investment opportunities. Information on foreign investments and markets is now more accessible and thorough. That's the internet. Some United States financial institutions offer their customers opportunities to invest in foreign securities and emerging markets at relatively low transaction costs. This is a big one. It was very difficult before technology, like the internet and all of this fintech stuff, for somebody from a different country to invest in the United States. There was a lot of hurdles, a lot of things, and high fees. And the high fees were not necessarily from the United States side, was from the side of the country they were in. But now, with all this facilitation of, provided by technology, people can directly handle. There is some paperwork, there's some hurdles still, but they can easily directly manage accounts in the United States. And any of the country for that matter. It's just that we're in the United States, so we're talking about that without going through too many hurdles between their country and the United States and everybody in between. So more on the globalization. The euro is having a notable impact on the global financial system. Now let's remember that the euro, it's maybe like 25 years old or so. So yeah, it sounds like a long time, but it's a young currency compared to everything else out there. So as the European Union has developed, the euro has had more and more impact as a world currency. Economic growth in Pacific Basin countries, China, and other emerging countries has resulted in significant growth in their stock markets. Yeah, the whole Asian aside, there's been a lot of development there. China, an obvious one, everybody hears about in the news all the time, but they're not the only ones. They're just the biggest one. Deregulation in many foreign countries has allowed international investors greater access and allowed the deregulating countries to expand their investor base. In other words, more free trade. That's just if I was to do like a term, an overarching term, it's saying more free trade. Now, not free trade for everything, but when it comes to these investments, they just make it easier and they lower barriers and make it more open, which is a good thing for everybody. And that's it for this video. See you on the next one.